Hello? How's it going? Let's start the video. Let me have a quick sip of this. And this is 5 reasons to hold Charlie Munger's biggest mistake. I bought Alibaba just a few months after Charlie Munger did way back in 2001. That feels like so long ago now. I knew Charlie Munger had purchased Alibaba thanks to a site called 𝗢𝗙𝗪𝗪, which collects data on all of the world's greatest investors. Through this site I could see all of Charlie Munger's SEC filings, and I could see that he had purchased Alibaba at around $245. Sorry, there's a helicopter. Due to the fact that SEC filings are released 45 days after the period at which they are filed, that meant that I was getting not only the seal of approval of one of the world's greatest investors, I was also buying at a better price than him. What came next was crazy though. The stock became a massive falling knife and the share price just kept dropping to the point where it is now sat at a price to earnings of 10. And before passing away at the age of 99, Charlie Munger did something a bit out of the ordinary and admitted that he made a massive mistake. Of course, this was the headlines though. In reality, his words were a little bit more subjective than that. If you're curious, this is the clip that Charlie Munger said that he made a massive mistake.
I regard Alibaba as one of the worst mistakes I ever made. In thinking about Alibaba, I got charmed with the idea of their position on the Chinese internet. I didn't stop to realize they're still a goddamn retailer. It's going to be a competitive business, the internet. It's not going to be a cakewalk for everybody.
So there it is, there's the actual clip. You can interpret that however you like. However, I interpret it as Munger saying that his expectations were just a little bit too high for the business. He had priced it as an internet company when in reality it was just another retail company. A retail company that uses internet. Bezos actually acknowledged this in an interview decades and decades ago when he said it was internet sminternet. It's just a retailer company that uses the internet to provide better customer service.
It doesn't matter to me whether we're a pure internet play. What matters to me is do we provide the best customer service. Internet, schminternet.
So to reiterate, I don't think he made a mistake buying the business Alibaba. I think he just regrets the price that he paid for the business and the expectations he had on the earnings. Backing up this view is the fact that Charlie Munger still holds Alibaba, a massive chunk of it, in the Daily Journal, his private hedge fund. I am absolutely certain that if he regretted buying the business Alibaba, not just the price, he would have absolutely cut his losses and sold his position. Another thing I think he regrets is purchasing the business during the pandemic. Internet companies did incredibly well during the pandemic. However, retail companies obviously suffered, and he'd missed the fact that it was a retail company, not an internet company. Also, it's worth noting that the pandemic was really bad to Baba, but it was not devastating. Ordinarily, Alibaba would make over 100 billion Chinese yen in earnings alone, and during the pandemic, it made a measly 13 billion in Chinese yen. However, it was still profitable. Obviously, dropping from 150 billion yen down to 13 billion yen is going to have an enormous impact on any company's share price. However, now the stock is returning back to its previous highs. The last year it made 130 billion yen in earnings alone. And so this is the first reason that I am going to be holding the stock in 2024. So this is the part of the video where we stop trying to interpret the actions of a dead man. We now need to create our own assumptions as to why we want to purchase Alibaba. And so these are my 5 reasons that I'm going to be continuing to hold Alibaba and why you potentially might want to buy shares yourself. Right, the first and biggest reason is price. The price to earnings of Alibaba right now is 10, which is like an all-time low. If the earnings go back to their 2019 high, which I believe they will, the current price to earnings would be 8.5. So the price to earnings right now is ridiculous. A typical price to earnings for a company like Alibaba, especially with its space in retail, e-commerce and the internet and its cloud computing business, typical price to earnings should be around 20, due to the fact that these companies can grow incredibly fast, which leads me nicely into point number 2, growth. When it comes to predicting growth, I believe past growth is one of the worst indicators in predicting future growth. I can think of tons of examples from this in the financial world, but I think this goes down to nature at its core. The animal that eats its lunch fastest has to work hardest to find its next meal. Instead, I think the best indicator for growth is looking at a company's earnings relative to their expenses. In the case of Alibaba, they're currently making 132 billion Chinese yen in earnings, and it cost them 570 billion yen in order to get those earnings. Simply, that means in the last year, Alibaba spent 77 cents purchasing $1. To put that into context, Amazon in the last year spent 93 cents getting $1. And remarkably, the king of earnings, Apple, spent 63 cents purchasing $1. Earnings relative to capex show how quickly an animal is eating its lunch. So if it's really cheap for a company to purchase $1, that means they've got loads of food left on their plate. And it means that they can reinvest this income into the business much more easily, and it should be more effective going forward into the future. That means that they will grow much, much faster. But we haven't just used past growth in order to predict future growth. We found a tangible advantage as to why it would be easier for them to grow faster. But there is a way that companies can grow that can absolutely destroy a business. So now let's look at the debt. Fortunately for Alibaba shareholders, we don't really have to worry about this at all. Alibaba has basically no debt. It actually has 3 times more cash than debt. So that's nice and easy. There's not much to say on that. Let's move on to the next reason I like Alibaba, and that is its moat. For millions of people in Asia, Taobao and Tmall are their version of Amazon. And despite making massive profits, Baba are investing aggressively into their production line. And it also benefits them that a lot of the robotics manufacturing goes on in China. So they get it at great prices and they live right next to where these things are getting made. All this investment is to make sure that getting the product from the factory to the end consumer is as cheap as possible. If you don't know, a lot of the cost of getting products to consumers happens within the last mile. And it's something that is one of the reasons that Amazon are investing in their drones, but it's much harder for Western countries to deliver products to the last mile. And it seems that Asian customers don't steal and vandalize the delivery robots nearly as much as Western customers do, which helps enormously with cutting costs. So I don't see customers losing interest in e-commerce, and I don't see competitors out investing Alibaba anytime soon. It's also worth noting that Baba has a massive cloud business, a lot like Amazon Web Services, which provides an enormous amount of income for the business. This is one of the things that saved it during the pandemic. All this is to say is that Alibaba is a fast-growing e-commerce tech giant that even in its worst year still earned more than it spent, and it's currently priced at 10 times earnings. So I can see in the comments already, someone's going to say, what about Taiwan? What about the Taiwan threat? Well, I don't think I'm the most qualified to answer on this. Charlie Munger got asked this exact question in a recent interview, so I'm just going to let him answer.
Well, that's a very good question, of course, but I would argue that the chances in a big confrontation from China have gone down, not up, because of what happened in the Ukraine. I think that the Chinese leader is a very smart, practical person. And it doesn't, Russia went into the Ukraine because it looked like a cakewalk. I don't think Taiwan looks like such a cakewalk anymore. I think it's off the table in China for a long, long time. And I think that helps the prospects of investors who invest in China.
I agree with Charlie Munger. I think after Russia-Ukraine, the likelihood of China attacking Taiwan has gone down. However, if we've learned anything from history, like the Battle of the Bulge in World War II, it's that it doesn't always matter to someone that they are likely to lose. Unless you can accurately work out someone's psychology, the psyche of the person in charge, you have absolutely no idea what they're going to do. What we've learned throughout history is that things like land represent huge trophies to politicians at whatever the cost. This is why, even though I think the likelihood has gone down, I can't price the Taiwan risk. So whatever the risk is, it isn't zero. So that alone is what makes me say I wouldn't put more than 20% of my portfolio into China. Therefore, if I'm right and Chinese stocks do massively outperform US stocks, you're still going to be benefiting enormously, but if things go the wrong direction, you won't lose too much. The final thing I want to say on this matter is the people that bet on peace typically outperform the skeptics. Finally, I want to put my Alibaba thesis in the simplest terms possible. The greatest investor on the planet bought it and liked it at $245 per share. Today, the share price is at $70. If you invest $1,000 in it today, by the time it reaches Charlie Munger's share price, you would have made $3,000. And that's assuming that it doesn't go up to $300 and $500 and beyond, which, if all goes well, I think it probably will. However, the thing you need to do if you really want to be rich is